Do you still think at this point Bitcoin is pretty tied into sort of the global macroeconomic picture, and that's really in the driver's seat of what's going on?
I think so. I think it's totally beholden to the macro picture. Obviously, you see these pumps and dumps here and there off of Bitcoin-centric news, but at the end of the day, Bitcoin is a macro asset, and it's a macro asset that's really very, very tiny, and therefore it gets thrown around in the waves of this big macro ocean of liquidity. The reason I feel so comfortable saying this is because the price of money is at an all-time high. Well, not an all-time high for my lifetime, certainly, but at the very least a decade, if not multi-decade high. Money has never been so expensive, and also the rate of contraction of money supply is at its deepest contraction since the early stages of the Great Depression. So if you think about it that way, if you think of Bitcoin as this asset that's meant to absorb all of this excess liquidity, but all of a sudden that excess liquidity is being drained like an abscess, then Bitcoin really doesn't have much of a reason to skyrocket into the stratosphere. So from a macro perspective, I think it's really influencing Bitcoin heavily to the downside. Those are the headwinds facing Bitcoin. Whereas things like ETF approval, those Bitcoin native aspects, as well as Bitcoin supply schedule, the amount of Bitcoin being issued, getting cut in half, that eventually will play a positive role in Bitcoin's price action. But I think those negative forces of money supply contraction and interest rates are really what are pushing Bitcoin down.
Now, I know you pay attention to liquidity, and I think maybe you tweeted out yesterday or day before about just how liquidity is retreating, kind of to the point you said, sort of at the fastest rate in history, and that is true. But at the same time, we still have a lot of liquidity in the system. Because we had, between the Fed and between fiscal and monetary inflation, we had about 11 trillion pumped into the system in about 2 years. And so that's still sort of sitting there, it seems like. And that would be my base case as to why equities are holding up so strong in the face of this rampant, rate increase, while at the same time, the bond market is telling us there's certain danger coming, but equities are still raising to new all-time highs. First of all, if you want to comment on that, and then second of all, if the answer is yes, you think maybe that could be part of it, then why has Bitcoin sold off so much while equities have been able to continue to rally?
I think that is part of it. If you look at it from, obviously we talk about growth and we talk about the rate of change, right? M2's rate of change is its deepest negative in almost 100 years. Okay, great. But to your point, this is just a mean reversion, right? There's a rate that the money supply goes up. It goes up and to the right. But then all of a sudden in 2020, there was this huge bazooka of money that was blasted into the system, and it went like this. So now the process we're going through right now is just a reversion down back to that historical rate of growth. And so for that reason, that could be the reason that there is still ample liquidity in the system, and you haven't seen a huge explosion in things like major equity indexes just yet. As for how that's impacting Bitcoin, I think it just comes down to a behavioral shift in investors following that monetary bazooka. I think there was a great deal of hysteria that came into the Bitcoin market during 2020, 2021, and of course into 2022. And I do think a lot of that hysteria is moving away. The reason I think this de-risking came for Bitcoin first prior to equities is because, like I said, it's higher beta, a lot more leverage in Bitcoin. Right now, leverage is propping up the market more than it ever has over spot buying, but also it's very illiquid, right, compared to things like the S&P 500. So as investors de-risk, I have a feeling, because spot buying is virtually non-existent in Bitcoin right now, and it's a high-risk asset, they move the liquidity moves from that asset first, whereas the S&P 500 is still able to be supported, particularly on relatively strong earnings growth. Over the last couple of quarters, earnings have really done well, and so equities are still being supported. I think the tide will turn there based off two factors. One, really attractive rates. I may think the U.S. Treasury, with the amount of debt that it's issuing, is super irresponsible, but the reality is investors love when there's higher and higher yielding debt. And so as debt continues to be attractive, investors will move away from equities. But I think the nail in the coffin for the S&P 500, eventually, which will lead it to follow Bitcoin, is when earnings start to disappoint. And for now, that's not going to happen until corporate debt has to roll over, which hundreds of billions of dollars worth of corporate debt is maturing at the end of this year, but primarily 2024 and 2025. Those are the 2 years to watch where earnings really start to deteriorate and the S&P 500 snaps back to reality. Could happen before that, could happen during that, but I think eventually the S&P 500 will follow Bitcoin in its de-risking pattern here.
Yeah, I love that point that you brought in the beginning about the M2 supply. While it is falling at the fastest rate in 100 years, to your point, it's falling back to the mean. It was sort of like I was talking about before, previously, not today, but on another video, but oil prices and all these headlines. Oil prices are plunging. They're plunging. They're plunging. Yeah, they plunged all the way back to where they were pre the little spike that we had, during the war with Russia broke out. And so it's like important to understand the direction and the speed, but also sort of understand where that mean average is as well. I guess that's what you're saying.
Yeah.
Yeah. So liquidity is plunging, but it's still pretty high, which is why stocks are still doing pretty good. Now, a lot of it has to do with, to your point, like the direction that we're going. And so all eyes are on Jerome Powell, the head of the Fed, trying to tell us where the price of this money is going to go, where it's going to end up. They had the meeting last week in Wyoming. It seemed to me it was what we call Fed speak, a lot of kind of talking out of both sides of your mouth, like, hey, we're kind of waiting and watching. We could do more if we need to, but we don't know if we will because we have to be prepared for either way. Is that sort of what you took out of it? Do you think it was sort of like evenly hawkish and dovish at the same time?
It is. Ultimately, the Fed needs to straddle that line between not spooking the markets and creating this, the pushing the wealth effect in the other direction.
But a lot of times they're trying to really project out in advance what they're going to do because they don't want to spook. To your point, they don't want to spook the markets. Typically, they say like before they started raising rates, they announced several months before they were going to do it before they did. So sometimes they're trying to kind of lead you. Mm-hmm. So are they leading us into neutral territory?
It seems like it. The Fed does what's called forward guidance, which exactly like you said, they don't want to spook the markets. And so they kind of tell you ahead of time exactly what they're going to do. It's all about setting expectations and keeping to them. And they're kind of setting the expectations for that. They're going to be on hold, right? And the reason being, Jerome Powell said, as is often the case, we are navigating by the stars under cloudy skies. That was a quote from him. That's kind of disconcerting from the guy who's setting the price of money for the entire United States and all of U.S. dollar capital markets. But essentially, what he's saying is that the Fed has two tools, okay? It has interest rate setting and it has its balance sheet. Right? It can influence rates and it can buy stuff with his balance sheet or the money printer, right? And these two tools, both of them work with long and variable lags. It's a phrase that Jerome Powell has said multiple times, which tend to be about 18 months or longer. And so now that we're about 18 months away from the Fed's first rate hike, these lags are finally trickling down from the Fed's monetary gavel to actually tightening financial conditions. And so when he says we're navigating by the stars under cloudy skies, essentially he's saying, yeah, we're using this business data, these tools, but now we're entering into a realm of uncertainty. So now that the lags are finally hitting, we're very uncertain about the outlook. And so he's setting the expectation that we're now entering the period where things are going to start to get hairy. And Powell just said it in a very overly poetic way. So that's what I think I got out of Jackson Hole. Not overly hawkish, not overly dovish, just determined. We're going to keep rates here, but fair warning, the economy is beginning to unravel, and we don't know what that's going to look like.